Today we're going to look at two different closed-end funds, which are the Liberty All-Star Equity Fund, ticker USA, and the Liberty All-Star Growth Fund, ticker ASG. These two funds were requested over on our Patreon not long ago, and there are some things that stand out about these two investments. They're both pretty similar, which is why we're going to take a look at both of them for this video. Both of these two funds currently offer high yields of over 8.5%, and they're both diversified in that they hold investments across different sectors. So today we're going to compare both of these two funds and try to determine which one might be the best for dividend and growth investing. With that being said, let's go ahead and get started. Let's start by taking a look at the Liberty All-Star Equity Fund, ticker USA. USA invests in the public equity markets in the United States, and the fund seeks to invest in stocks of companies operating across diversified sectors. It primarily invests in value and growth stocks of large cap companies, and their investment objective is to seek total investment returns comprised of long-term capital appreciation and current income. Under normal market conditions, USA invests in at least 80% of its net assets in equity securities, and up to 20% of the value of USA's net assets may generally be invested in short-term money market instruments. It's a pretty old closed-end fund that was launched back in 1986, and USA employs a rather unusual strategy when it comes to managing their fund. According to their website, the fund allocates its portfolio assets on an approximately equal basis among several independent investment management organizations, having different investment styles recommended and monitored by ALPS advisors. So USA splits the assets inside of it 5 different ways, and they have 5 different companies managing it simultaneously. 3 of the managing companies focus on value stocks, and 2 companies focus on growth stocks. The 5 companies that manage USA include Aristotle Capital Management, Fiduciary Management, Pzena Investment Management, Sustainable Growth Advisors, and TCW Investment Management Company. You can read the different strategies that each manager pursues on their website. The second fund we have is the Liberty All-Star Growth Fund, ticker ASG. The fund invests in the public equity markets in the United States, and they seek to invest in stocks of companies operating across diversified sectors. The fund primarily invests in growth stocks of companies across all market capitalizations, and they employ fundamental analysis with a bottom-up stock picking approach to create its portfolio. ASG was launched back in 1986 just like USA, but ASG is the oldest of the two, having launched back in March of 1986. Also, just like USA, this fund also follows a very similar format, where they have outside companies managing its assets. ASG's assets are split equally among 3 managers, all who pursue different investment styles. Weatherby Capital invests in small-cap growth stocks, Congress Asset Management invests in mid-cap growth stocks, and Sustainable Growth Advisors invest in large-cap growth stocks. The main difference between these two funds is that ASG tries to pursue growth at a faster rate than USA does. USA has roughly 60% value, and it's 40% growth according to their website. I'm going to go through a series of comparisons to help determine which of these funds might be the best option for investors. Starting first, we're going to assess the dividends these two funds pay. Both funds pay quarterly dividends, and how much they pay can vary a lot depending on the quarter. While these might be good picks for people who enjoy dividend investing, they're not ideal holdings for people looking to live off dividends. There can obviously be some lifestyle challenges if you collect $800 one quarter from these funds and then $600 the next. The reason for this is that both these funds earn their revenue from realized gains inside the fund. It's unlike most closed-end funds that exist who fund their dividend payments from interest income. This explains why when the share prices of these funds grow, so do their dividend distributions. But when the market falls, then the dividend distribution amounts also fall. You can see that they're pretty much correlated with one another. As of the making of this video, USA currently offers the highest dividend yield at 9.89% compared to ASG's 8.75%. They're both really high, but USA does have the upper advantage. According to Seeking Alpha, USA also has a slightly better 5-year dividend growth rate compared to ASG. For this reason, I'm going to give this check to USA for this category. Let's now take a look at the expense ratio for each fund. When I first came across these funds, I was pretty certain that both were going to charge really high expense ratios considering how they're structured. When you have 3 companies or 5 companies all managing these funds, I assumed that would translate into higher fees for investors. But fortunately, the expense ratios for both these funds are pretty reasonable even by CEF standards. ASG currently has an expense ratio of 1.14% according to their website, but USA has an expense ratio of 0.93%. So the winner in this category is going to have to be USA because it's a cheaper holding to invest in. Let's now take a look at the holdings inside each fund and see which is better diversified. The more holdings they have, the more safety that's going to come along with it. According to Seeking Alpha, ASG has 120 holdings in it, with their top 10 positions making up 19.48% of this fund's portfolio. The 2 biggest sectors are technology and healthcare stocks, which combined make up 45.9% of this fund. They're also invested in other sectors like consumer cyclicals, financials, and consumer defense and so on. USA, on the other hand, has 147 holdings as of December 31st, and their top 10 holdings make up 18.32% of their overall portfolio. Their largest positions include companies like Microsoft, Visa, United Health, and Amazon. Obviously, since this is their value fund, they're going to focus more on recognizable companies here. When looking at the sectors, USA is pretty comparable with ASGs, but there are a few differences. The biggest one is financials, followed by technology. These two make up 43.12%, which is lower than ASG's top two. But besides that, the two are pretty similar to each other. But considering USA has more holdings and it's just slightly better diversified, I'm also going to have to give them the check in this category as well. Let's look at another important metric for a closed-end fund, which is whether the fund's currently trading at a premium or a discount. A distinct feature of these kinds of investments is that some of them can trade at really sizable premiums or discounts to their net asset values. It's usually better to buy a CEF when it's trading at a discount because that indicates you're buying into the fund at a cheaper price than the value of what's actually inside the fund. The ASG is currently trading at a 4.74% discount and it has a 52-week average of minus 0.28%. So this means ASG typically trades at a fair value, but it spends more time going for a discount as opposed to a premium. With USA, the fund is currently trading at a 0.67% discount. So although it's not very much of a difference, ASG is still slightly more on sale. USA is also more likely to trade at a premium compared to USG, but as I've mentioned before in the past, it could be that the market's just willing to pay a higher price for USA's quality. But for this category, I'm going to have to give it to ASG on this one. Finally, let's do a 10-year total return calculation. Using a DRIP calculator, which will show us the total return for a dividend investment with dividends being reinvested, we're going to see which fund has performed the best over the last 10 years. And although it is somewhat close, USA just barely beats out ASG. USA was able to provide an average annual return of 10.98% compared to ASG's 9.75%, but both these funds did pretty well over the same time period. If you would have invested $10,000 into both funds, you would now have $28,335 in USA stock and $25,347.47 if you invested in ASG. For this category, I'll have to give it to USA, although it was reasonably close. But with that being said, the winner for this comparison is going to have to be USA, considering they beat ASG in most categories. In the end, I think either of these two funds would make decent picks, but I prefer USA in this situation. But given just how much their dividends can vary each quarter, and especially during different market conditions, it would be really hard to someday live off the dividends from these two investments, which is something that I look for whenever I invest in a dividend holding. I'm fine with investing in some securities that have a varying dividend, but these two see their distributions vary a lot in short amounts of time. But regardless, they've still provided good returns if you're not interested in trying to live off the dividends from these two. Since ASG focuses more on growth, it might actually outperform USA during a decent bull market. But with that being said, that's going to wrap up today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus, it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.